This video will show you how to complete the Chapter 2 comprehensive problem from beginning to end. So Jasmine Worthy started a haircutting business called Expressions. The following events occurred during the first month. December 1st, Worthy invested $3,000 cash and $15,000 of equipment in Expressions in exchange for common stock. So the things that are being affected here are cash, equipment, and common stock. So cash is an asset. The business's cash will be increasing by $3,000. Equipment is also an asset, and it will be increasing by $15,000. Common stock is an owner's equity account, and owner's equity as well as common stock will be increasing by $18,000. So at the end of this equation, the way that we look at it, we can see that the left side, so assets, have increased by a total of $18,000, and the right side, owner's equity, has increased by $18,000. So with that information, then we look at the types of accounts these are and figure out whether we will need to debit or credit those accounts to properly show how they're increasing. So we'll first look at cash. Cash is an asset. Assets increase with a debit. So that means since cash is increasing by $3,000, we know that we will debit cash $3,000. So the date is December 1st. We're debit cash $3,000. The next account that we'll look at is equipment. Equipment is also an asset. Assets are increased with a debit. So we will debit equipment because it's increasing. Debit equipment $15,000. And in this example, there are 3 accounts. So now we have to show our credit here. The rest of these transactions only have 2 accounts in each journal entry. But for this one, we also have one more account, which is common stock. Common stock is an owner's equity account, and it is increased with a credit. So we credit common stock $18,000. So at the end of our journal entry, we have used at least 2 accounts, and our total debits equal our total credits. And so now we can just look at what we would do in terms of posting. So posting to the T accounts. I have 3 blank T accounts down here. We will label them with the accounts that we're using, which are cash, equipment, and common stock. We debited cash. Remember, debit is on the left and credit is on the right. So we debited cash $3,000, debited equipment $15,000, and credited common stock $18,000. December 2nd, Expressions paid $600 cash for furniture for the shop. So this is December 2nd. Cash and furniture are the 2 accounts that are being affected. These both happen to be assets. So when we're looking at our accounting equation, the effects of this transaction are both on the asset side. So cash and furniture. So since cash is being paid, that means cash is decreasing. And since furniture is being acquired, the amount in the furniture account will be increased by $600. So the overall effect of this transaction is, in terms of numbers, things really stay the same for the asset category because assets went down $600 in cash, but also up $600 in furniture. So there's kind of a zero net effect in terms of changes. But when we look at how to record this, we first need to figure out what we debit and what we credit. Remember, I told you if you always look at cash first, because usually cash we can kind of remember a little better, Cash we know is an asset. Assets are increased with a debit. But what's happening here is not an increase. So therefore, we know it's going to have to be the opposite. So since cash is decreasing, we will credit cash. 600. Furniture is also an asset, and it is increasing, and that's great because assets are increased with a debit. So we know we will have to debit furniture. 600. And then looking at the T accounts, cash and furniture. Cash is being credited 600, so cash is decreasing. We credit cash 600, and furniture is being debited 600. December 3rd, Expressions paid $500 cash to rent space in a shopping center for December. So what's happening is cash is being paid for rent. So this is December 3rd. Cash is being affected. We know cash is an asset. Cash is decreasing by $500 because it's being paid out. It's being paid for rent expense. Expenses go under owner's equity. So assets and liabilities are fairly straightforward. Owner's equity is made up of several different things. So owner's equity also involves any capital. So anything that the owner puts in, common stock, and revenues all increase owner's equity. The things that decrease owner's equity are expenses and either draws or dividends. So essentially, anytime the owner puts money into or takes money out of the business, that affects owner's equity. Anytime revenues are recorded or expenses are recorded, that affects owner's equity. In this case, we're looking at rent expense. An expense decreases owner's equity. So owner's equity is being decreased by $500, and that's for rent expense. So let me talk about just for a minute the relationship between expenses and owner's equity. When we record an expense, we record it as a positive number. So I'll just go ahead and tell you, when we debit rent expense, it's recorded as a positive $500 because we're showing the accumulation of expenses over time. But as expenses increase, overall, that makes owner's equity decrease. So that's why we have a negative 500 here, showing that owner's equity is decreasing by $500, just the same as cash is decreasing by $500. So we know that we debited rent expense because expenses fall on the side with a normal debit balance, meaning that expenses are increased with a debit. Something to remember is that 99% of the time that you record anything to an expense account, it will be a debit. Anytime you record expenses, they're debited. So whether it's rent expense, utilities expense, telephone expense, wages expense, you see the word expense 99% of the time. If it is an actual expense being incurred at that moment, you will debit the expense. So then cash, we know, is an asset. Assets are increased with a debit, but what's happening in this transaction is not an increase to cash. It's a decrease to cash. When we pay out cash, it's a credit. So credit to cash of $500. With our T accounts, we have rent expense, cash. Rent expense is being debited $500, and cash is being credited $500. December 4th, Expressions purchased $1,200 of equipment on credit. So equipment and purchasing something on credit means that you're not paying cash for it. So we're not having cash involved in this. Instead, we will use accounts payable. And that will give us a record of what we owe to pay out cash later. So this is December 4th. Equipment is an asset, and it is increasing by $1,200. Like I mentioned, the other thing that we're recording is accounts payable, which is a liability. And we will record an increase to accounts payable of $1,200. So for our journal entry, let's start with equipment. We know that equipment is an asset, and assets are increased with a debit. So we'll debit equipment $1,200. Then accounts payable. Accounts payable is a liability. Liabilities are increased with a credit. So we credit accounts payable $1,200. For our T accounts, we have equipment and accounts payable. Equipment is debited $1,200 and accounts payable is credited $1,200. On December 15th, expressions opened for business. On December 5th, cash received from haircutting services in the first week and a half of business, which ended on December 15th, was $825. So this is cash received between December 5th and December 15th. We're going to record it on December 15th to show all the cash that was received during that first opening period. So obviously cash is being received, therefore cash will be recorded. And that's an increase of $825. The other thing that has to be recorded is the revenue generated. So revenue is generated by providing products or services. Here, services were provided, services of $825. So we record that as service revenue, which is a revenue account. And remember, owner's equity is affected by revenues. So service revenue of $825. So then looking to actually record the journal entry, if we look at cash first, cash is an asset. Assets are increased with a debit. So we know that we will have to debit cash, $825. Revenues are increased with a credit. And since revenues are increasing here, we credit service revenue, $825. For our T accounts, we have cash and service revenue. Cash is debited $825. Service revenue is credited $825. December 16th, expressions provided $100 of haircutting services on credit. So there was no cash to change hands at this point. Revenue was generated because services were provided. So this is service revenue. But again, there was no cash. Services were provided on credit. So we will record this as accounts receivable, because we do have to record an asset, but we don't record cash because we haven't received the cash. Instead, we record the asset accounts receivable. Then later down the line, the company will receive the actual cash for that. So the asset that's impacted is accounts receivable. And that is an increase of $100. And then service revenue is being recorded also of $100. The date is December 16th. Looking at accounts receivable is an asset, which is increased with a debit. We're debiting accounts receivable. We're increasing the amount on the books to show that we will be receiving $100 in cash in the future. So we debit accounts receivable, $100. And then to record a revenue, revenues are increased with a credit. So we credit service revenue, $100. T accounts, we have accounts receivable, debited $100, and service revenue, credited $100. December 17th, Expressions received a $100 check for services previously rendered on credit. So previously rendered on credit, just in the example before this, remember we recorded that with accounts receivable. If you receive a $100 check, when you put that in your bank, it's basically the same as cash. And for that matter, anything in your bank account on your books is actually considered cash. So a check is like a cash equivalent. We still count it as cash. So what's being affected here is cash that we're receiving to go toward the amount that was previously recorded as accounts receivable. So this is December 17th. Cash is being affected. I'm actually going to scoot this over. Cash is being affected and accounts receivable. They're both assets. And what's going to happen is cash is being increased by $100 and being put toward the account receivable balance. So now we need to decrease the balance for accounts receivable because they've paid that now. So we decrease the amount that we plan to receive in the future because we've now received it. So cash is an asset. Assets are increased with a debit. So we debit cash for $100. Accounts receivable is also an asset. Assets are increased with a debit, but remember here we are decreasing the asset. So we will credit accounts receivable. For our T accounts, we have cash and accounts receivable. Debit cash, 100, and credit accounts receivable, 100. December 18th, Expressions paid $125 to an assistant for hours worked for the grand opening. So paid $125, that will be cash. And the expense that we will record for this will be called wages expense because you're paying someone wages. So cash is an asset. Cash is decreasing by $125 because it's being paid out. The other thing that's affected in this is owner's equity. Owner's equity is decreasing because remember, expenses decrease owner's equity. It's called wages expense. And that's a decrease to equity of $125. It's an increase to the actual expense account, but big picture, looking at the accounting equation, it's a decrease to equity. So for the journal entry, the date is December 18th. We look at cash. Cash is being affected. Cash is an asset, and assets are increased with a debit. But here cash is being decreased, so we will credit cash. Expenses, wages expense. So expenses are increased with a debit. Anytime you record an expense, it will be a debit. So debit wages expense. And the amount is $125. So we have wages expense and cash for our T accounts. Wages expense is debited $125. cash is credited $125. Remember, another tip I told you was always figure out cash first, whether it's your debit or credit. Then you'll know the other one. December 31st, cash received from services provided during the second half of December was $930. So cash received of $930. And since this is because services were provided, that is generating revenue, which is service revenue. So cash is an asset. Cash is increasing by $930. Revenue impacts owner's equity. Service revenue is increasing by $930. So for the journal entry, it's December 31st. We have cash. Cash is an asset. Assets are increased with a debit. So since cash is increasing, we debit cash $930. And then to record revenues, revenues are recorded with a credit. So we credit service revenue $930. Post to the T accounts for cash and service revenue. Cash is $930 and service revenue is credited $930. December 31st, Expressions paid $400 cash toward the account payable from December 4th. So remember in the previous example, on December 4th, they recorded an account payable, and that was when they purchased something but did not pay for it with cash immediately. So now in this journal entry, we will record them actually paying the $400 cash. So this is December 31st. Cash is being impacted. We know cash is an asset, and since cash is being paid, it's decreasing by $400. The other thing that's happening is the account payable, which represents the amount to be paid later. That will need to be decreased since $400 is being paid now toward that. So for our journal entry, we look at cash. Cash is an asset, and assets are increased with a debit. However, cash is decreasing here, so cash will be credited $400. And accounts payable is a liability. Liabilities are increased with a credit, but again, accounts payable is being decreased. So if a liability is increased with a credit, then it is decreased with a debit. So accounts payable will be debited. Also $400. For our T accounts, we have cash and accounts payable. Cash is being credited $400 and accounts payable is being debited $400. Also on December 31st, Expressions paid a $900 cash dividend to Worthy, who was the owner, the sole shareholder. So we know that cash is decreasing. Cash is an asset. It's decreasing by $900. Where dividends fit into this is under owner's equity. Remember, anything that involves the owner putting money into or taking money out of the business is basically one of the main parts of owner's equity. So the account is called dividends. When dividends are issued, they decrease owner's equity. So that will decrease owner's equity by $900. Anytime a dividend is issued, it will always be a debit. So over here, make sure you know that draws and dividends are the same thing. Draw is like a withdrawal that the owner makes, and dividends are the same thing. It's when money is issued from the business to the shareholder, to the owner. So it's December 31st. If we look at cash first, cash is an asset. Assets are increased with a debit. However, cash is not increasing, it's decreasing. So cash is decreased with a credit. Anytime cash is being paid, it's a credit to cash. And that is $900. Draws and dividends are recorded with a debit. So we debit dividends, $900. And so what I'll say about this in terms of the minus sign here, this is the same way that owner's equity is affected by expenses. So when expenses are recorded, when dividends are recorded, they decrease owner's equity. So you debit an expense, you debit a dividend to record them, but overall the effect is that they are decreasing owner's equity as a whole. So our T accounts here are cash and dividends. Cash is being credited $900. Dividends is being debited $900. So now that all our journal entries have been recorded, on each of the previous slides, I showed you how to post each individual journal entry to a T account. But now what we want to do is look at all the journal entries and how cumulatively they impact the T accounts, or the general ledger is what the T accounts represent. So to make sure that we can kind of identify which numbers go along with which journal entries, you can see that I have ordered each of these just A, B, C, D, E, F, G, the journal entries, so that you can keep track of where the numbers are coming from. So we'll start with the first journal entry, which is labeled as A. We look and see what's affected. First, the cash account is being affected. So we are debiting cash $3,000. The next thing is equipment. Equipment is being debited $15,000. And then common stock is being credited $18,000. The next one, furniture, is debited $600. And cash is credited $600. C, rent expense is debited $500. And cash is credited $500. D, equipment debited $1,200. And accounts payable credited $1,200. E, cash debited $825. And services revenue credited $825. F, accounts receivable debited $100. And services revenue credited $100. G, cash debited $100. And accounts receivable credited $100. H, wages expense debited $125. And cash credited $125. I, cash debited $930. And services revenue credited $930. J, accounts payable debited $400. and cash credited $400. And then finally, K, dividends debited $900 and cash credited $900. So this shows you how each account is affected when you look at the whole period as being the month of December. So now what we'll do, especially for instance with the cash account, we need to figure out what the ending balance is for the month of December. So it helps for you to know the normal account balance of each of the accounts. Remember, the normal balance is whichever side increases that account. So for cash being an asset, the debit side is what increases cash. So therefore, the debit side is the normal balance of the account. And normal balance means that typically in a just normal given situation, this account should have a debit balance. And that's the case for cash. So if we add up all the debits, so 3,000 plus 825 plus 100 plus 930, those are all the increases in cash. Then we would subtract out 600 minus 500 minus 125 minus 400 minus 900. And what that will give us is a remaining balance in cash of $2,330. Okay, accounts receivable is also an asset, so it has a normal debit balance. Here it had an increase, so a debit of 100, and a decrease or a credit of 100, which would give it a zero balance. It increased by 100, then it decreased by 100, so overall the ending balance is zero. Furniture is an asset, so it will have a normal debit balance. The only thing that happened here is furniture was acquired for $600. Equipment, also an asset, so a normal debit balance, that would be $16,200. Then we have accounts payable, which is a liability. Liabilities have credit normal balances. So $1,200 minus $400 gives a balance of $800 in accounts payable. Common stock has a normal credit balance, $18,000. Dividends have a normal debit balance, so that balance is $900. Service revenues have a normal credit balance. Add up all those revenues, and that would be for the month $1,855. Wages expenses have a normal debit balance, so the balance there is $125, and the same for rent expense, balance of $500. So now what we can do is prepare a trial balance. And all a trial balance is the account balances at the end of the period. So at December 31st, what are the balances in all these accounts? Well, we just calculated those in the previous slide. So now all we do is pull those over into this trial balance format. So you can go back and look, but I will just complete these for you. So cash had a debit balance of $2,330. Accounts receivable had a zero balance. Furniture was $600. Equipment was $16,200. Accounts payable had a credit balance of $800. Common stock credit balance of $18,000. Dividends debit balance of $900. Service revenue credit balance of $1,855. Wages expense debit balance of $125, and rent expense debit balance of $500. So this is called a trial balance. So what we want to make sure, this is basically a double check, that all of our debits and credits are in balance. So with a trial balance, you add up all the debits. So for the debit column, that gives us a total of $20,655. and we want that to equal the amount of credits. So we add up the credit column. That also gives us $20,655. A couple of things that I want to point out here with a trial balance. The trial balance is where we get the numbers for the financial statements. So when we're preparing the financial statements in just a minute, we pull numbers directly from the trial balance. If you look at the way the trial balance is laid out, you notice first you have assets, then liabilities, then equity. Those make up the balance sheet. Then you have revenue and expense accounts, and those make up the income statement. We also prepare a statement of owner's equity, and so any of the equity accounts would go there also. You may also see it called Statement of Retained Earnings. So now we take the balances that we calculated on the trial balance and pull them over to the actual financial statements. The financial statements have to be prepared in a certain order, and the income statement always comes first because net income has to be calculated before going forward to other financial statements. So for the income statement, we're just looking for revenues and expenses. On the trial balance that we just completed, if you look at it, the only revenue account that was used for this business was services revenue, and it had an ending balance of $1,855. So that means for the month of December, revenue was $1,855. Then we look at expenses. Rent expense was $500, and wages expense was $125. Those were the only two expenses that the business had that month. We total those expenses to get total expenses of $625. So this represents total revenue. This represents total expenses. So you take total revenue minus total expenses, and that's going to give you net income of $1,230. So we need that to go forward to the statement of retained earnings, because remember, net income, so revenues and expenses, affect equity, and that's what we're looking at with the statement of retained earnings next. For the statement of retained earnings, we're looking just at the things that affect equity. So it's also called statement of owner's equity in different business structures. So what you basically do with a statement of retained earnings is you look at the retained earnings or the equity at the beginning of the period, any changes to equity during the period, and then what the ending balance for equity is at the end of the period. So like with the income statement, we were basically calculating net income. With the statement of retained earnings, what we're calculating is ending retained earnings. So the beginning retained earnings, the business didn't even exist on December 1st. So retained earnings at that point was zero. We add net income because net income increases retained earnings. Net income was $1,230. Subtract out anything that might decrease retained earnings, which in this case are dividends. There were dividends of $900, so subtract that out. That gives ending retained earnings of $330. Now, because that is a part of equity, we needed to calculate that before going into the balance sheet, because on the balance sheet we show assets, liabilities, and we need this for equity. Now finally for the balance sheet. The balance sheet basically shows all the balances in the accounts that show up in the accounting equation. So assets equals liabilities plus owner's equity. You can see we have assets, liabilities, and equity. It's called a balance sheet because we want things to balance. So just like on the trial balance, we had 2 columns that needed to balance. That's the same here. We want total assets on the left to equal total liabilities and equity on the right. So all we have to do here is plug in these account balances from our trial balance. So cash had an ending balance of $2,330. Furniture was $600. Equipment was $16,200. Add those all up. That gives us total assets of $19,130. Then for our liabilities, the only liability was accounts payable. Its balance was $800. For equity, we had common stock of $18,000. Retained earnings, we had to calculate not in the trial balance, but in the statement of retained earnings. Right before this, we calculated that ending retained earnings to be $330. So that gives total equity of $18,330. When we add together total liabilities and total equity, that gives us total liabilities and equity of $19,130. So we see that our balance sheet is in balance.